Hello everybody out there. In this second video I will continue to offer you a selection of road-tested management tools from the CFO perspective. Further videos will follow soon. My name is Truxius. I introduced myself in the first video and I have also added here a short information on my CV in the comments below to this video. The backbone of my videos is the concept of key performance indicators, KPIs. After the general introduction to this concept in the first video, we will now have a closer look at financial KPIs. As already mentioned in this first video, I will very soon make a separate video on non-financial KPIs. I'm quite sure that some of you are actually highly interested in non-financial measurement of economic activities and an extended view on the capital categories beyond financial capital, such as environmental capital and human capital. So am I. But I ask you to start here because, at least in my view, a solid knowledge of financial management instruments and tools remains the basis for running any organization in a sustainable way. Whether it is a large or small company, well established or a startup, and even for non-profit organizations, some of these financial instruments are very helpful for stable operations and financial survival. Let us now jump directly into my favorite financial KPI pyramid, the ROCE pyramid, which I have used successfully many times during my career as controller and CFO. This KPI system is primarily based on the elements of operating income and on the capital and asset components of the balance sheet. However, information on liquidity and cash flows, as well as on market values, are also used for certain KPIs inside this pyramid. In general, this ROCE pyramid is a substantial extension of the mother of all KPI systems, the so-called DuPont scheme, developed and implemented by this large American chemical company already 100 years ago. ROCE, the return on capital employed, is the top of this pyramid. It is not just the relation of operating income to the capital invested to generate this income, but it can be broken down in the next level of the KPI pyramids into two very useful components: the EBITDA margin and the capital turnover. Before we go on and further down the pyramid, it is necessary to define ROCE, EBITDA margin and capital turnover precisely. The first component of ROCE is the EBITDA margin on net sales, where EBITDA, the earnings before interest, tax and goodwill amortization, is my specific definition of operating income, and the EBITDA margin shows how many cents of operating income remain from €1 of net sales after the deduction of all the operating expenses. This understanding of EBITDA as the operating income is shared by the vast majority of practitioners. It is especially useful in the communication with operative managers and employees, because it measures their financial result before any influences that are beyond their control, such as different financing policies, that is the relation of debt to equity, and the always changing tax legislation, and last but not least, the effect of any impairments or regular amortizations of goodwill from acquisitions that were made by top management at high purchase prices in previous periods. It has to be mentioned, however, that there are other possible definitions of operating income, and that top management, of course, may not only look at earnings figures before this and that. Top management must, of course, also carefully watch and manage the bottom line, the earnings after tax. We will come back to these issues later. The second component of ROCE is the capital employed turnover, the relation of net sales to capital employed, which tells us how many euros of capital we have to invest to get 1 extra euro of net sales. For the measurement of capital employed, we have to dig into some details of the balance sheet. I will postpone that to the next video, which covers the details of ROCE calculation, and ask you for now just to believe the definition you see on the screen, which states that capital employed is equal to the sum of equity and interest-bearing debt, less cash reserves and non-operating financial assets. After all these definitions and general statements, I think it's high time to have a look at the real life and to make a short analysis how these KPIs have developed over time from 2008 until now at some iconic industrial companies. I selected some well-known German companies, all listed in the DAX 30. These are BASF, Bayer, SAP, Siemens and Volkswagen. I also added ThyssenKrupp, the famous steel company that had to leave the DAX 30 after 31 years due to a long decline in market value. You will find the download link to the following charts and tables in the comment below. All the calculations were made on the basis of publicly available information because, unfortunately, I do not have access to the internal management accounting data of these companies. But this is nevertheless a good first step into KPI calculations, because in reality, you often have the same limited data access when you analyze your competitors, your customers or your suppliers, and also, quite often, as a buyer in an acquisition situation, when the target company does not have a detailed internal cost accounting, which is the case more often than you would expect. At the first glance, we see in the ROCE chart that SAP, the German company with the highest market value, had extraordinarily good ROCE values for a long time. After their recent, very expensive, but obviously not so profitable acquisitions, SAP's ROCE declined substantially, but is still on a quite satisfactory level. We also see that ThyssenKrupp is now for years only slightly above the zero level, and in the next video I will show you that a ROCE of 0% is by far not enough for creating value. Instead, ROCE has to exceed the weighted average cost of capital before taxes, which, as a rule of thumb, is actually in the range of 7 to 10% per year. Therefore, this minimum requirement is also a challenge for Volkswagen since their diesel scandal. Further company-specific ROCE analysis will be presented in the next video. Turning now to the two ROCE components mentioned before, we compare ROCE in the left chart and the corresponding EBITDA margins on the right. Obviously, most of the ROCE movements over time are quite closely related to the EBITDA margin development of all companies. So we can conclude that the capital turnover seems to be quite stable over time. This is confirmed by the numbers in the next table, where small m is the symbol for the EBITDA margin and NCET represents very precisely denominated the net capital employed turnover. The extraordinary good, however declining EBITDA margins of SAP stand out, whereas their capital turnover is lower than one would expect for an asset-light software company, at least before the large acquisitions in the recent past. BASF and Siemens look rather healthy most of the time. So did Bayer before they acquired Monsanto. Volkswagen has a low capital turnover as a capital-intensive car manufacturer and suffers additionally from low EBITDA margins due to their widely discussed high production costs in comparison to their competitors. Finally, the EBITDA margin of ThyssenKrupp is on a totally unsatisfactory level since 2009. The improvements in capital turnover in some years could not ease that pain substantially. Of course, these comments only scratch the surface of the analytic power of the ROCE pyramid. But as already mentioned, we will come back for a more detailed analysis in the next video. And in that video, I will also discuss in more detail the questions of how management can set the right target value for ROCE and its components. This contains on the one hand some general economic principles, as well as on the other hand some industries and branch specific limitations. Thank you for now, and I hope you will be interested in the next videos. In my comments below you will also find links to some additional download materials.